Ladies and gentlemen of the crypto space, we're live at 11:32 a.m. on March 15th. It is Monday. It is the start of the new week, and there's a whole lot going on. Obviously, the macro backdrop is $1.9 trillion of stimulus, and a fair amount went out. Small credit unions got their deposits, and the vast majority all the big banks got the deposits too. The problem is the big banks can't accept the deposits. There's a whole treasury mess going on. Stephen Mann Meter covers it much better than I possibly can, but I understand his point, and it's extraordinary his capacity to understand the nuances of how the system works. And they literally can't release the funds until the Federal Reserve um, modifies regulations. The banks can't accept; they can't put any more money in their books. They're literally flooded with capital. Was it $3+ trillion of capital existed prior to this current stimulus? And that cash, that liquidity, just cannot fit on the big banks' balance sheets, and it's an absolute mess. What's going on? The banking system, just bonds and treasuries are absolutely perverted to the point where you can't even recognize what they historically were, and they're just there's nothing. There's nothing holy or kosher about what's going on in the financial system. It's an absolute not just fiasco, but it's just raunchy. You know what I'm saying? It's raunchy what's going on. Anyway, Dr. T's in the house. Always a pleasure. Montana, always a pleasure. Risk on versus risk off. That's a great topic. I always talk about risk off. It's just what it's been for a while now, and you need to understand risk off because even when stuff's going up, risk off is an effective position to be had, particularly because it's protective of your current portfolio balance. It's dollar protective, so there comes a point in time when risk off is the vast majority of your portfolio's position, even during risk on sessions. So risk on is really a purpose for capital growth, growth versus protection. Um, now, obviously, growth is something that everyone wants, even if you're in a relatively comfy position. It just depends how much you're applying and how much leverage you're applying to achieve growth. And that's really where I want to head today. We talk about dollar protective, we talk about stablecoin paired, double-sided pooling, which is a dollar protective position, and we talk about LP positions, which offers the ability to convert risk into yield, which is wonderful. And we talk about how Bancor is doing that in a very um, uh, in a special way, or at least in a novel way, especially as compared to like sovereign fiat systems and reserve banks, central banks around the world, and even compared to other AMMs at this point. Now, obviously, other AMMs have their ideology and their experience and capacity to program technology to achieve impermanent loss protection. And Hayden Adams was mentioning stuff, and obviously, uh, um, uh, bunch of folks. Yearn's got some stuff going on with regard to impermanent loss protection, but I don't like the word impermanent loss. I like double-sided pools with a stable coin, and I consider it dollar protective. Impermanent loss is specifically considering upside. You're losing the upside appreciation of an asymmetrically appreciating asset. So that's risk on, and the whole goal of impermanent loss protection is to avoid or to have full exposure to risk on while having the LP experience. And I'm at the point where there's no real reason to hold naked positions. The vast majority of positions are just superior when placed within an LP type of wrapper experience, whether it's to be full risk on, which you could achieve with a Bancor type LP position. Obviously, they're protected pools, not their double-sided pools, or you could have a dollar protective position with a stablecoin paired pooling, or you could have right in the middle, which is the double volatile pair pooling. And that's the whole point. The whole point of what we always talk about is balance. How much balanced are you risk on versus risk off? Now, this is an interesting topic I want to get into today. So I'm actually not in positions like that. Um, I saw an opportunity to take a increasingly risk on position, which does have me actually exposed to raw Ethereum. I typically don't hold much Ethereum other than what I want to do um, to operate in DeFi. Obviously, it's fuel, it's gas. And I believe that Ethereum is going to appreciate significantly. There's a constant buy pressure on the asset, merely to operate in the DeFi space, as I mentioned. But I think the the obvious play for the vast majority of capital long term is Bitcoin with a 200% appreciation factor year over year for the last 10 years. And that's where you store value and accumulate value. And there's merit to dollars as well because there's high yield on the money markets like Aave. And when risk on occurs, those yields spike significantly, 20, 30% at times. And that's exactly where we are. Let's take a look at Aave real quick. Ooh, I hope you load, Ave. Don't be unfair to me right now. Anyway, let's go through the intro. I don't have the main screen up. I got ahead of myself. Today's episode is sponsored by Change Angel, the non-custodial swap exchange for social good. Stop depositing on exchanges, not your keys, not your crypto, non-custodial, DeFi, or nothing at all. Bam! Let's pop it over to the main screen. I got to clear my settings, otherwise it doesn't load. Boop, 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 boop. Let's clear that up. See who's in the stream. You got Wave in the house. Captain Weber's in the house. Always a pleasure. William, up only unless down. That's right. That's right. And bing, bada, boom. Cruz, when Noah goes risk on, y'all know it's about to get bullish. Well, we'll take a look at the data. It's all about data that suggests whether it's a good idea or not. There's always risk. Lewis is in the house. Always a pleasure. How long was the DeFi risk off in September? About 3 months, January. We were live this stream through it all, bro. I don't stop, man. This is business. This is the time, the opportunity of 100 years to get in and ascend technology. Now is the time to go through bear. Bull. It doesn't matter whether it's bullish or bearish. There's always money to be made. Trevor in the house. Rita, yes, welcome. All right, you got that cleared. Let's refresh Aave. Let's get the money markets up. No, I don't want to load. It's probably not going to open unless I load. Give it a second. There we go. All right. So last night, when let's go with Ethereum because there's a nice trend formation. Bitcoin was in a descending, broadening wedge, which is basically right about here, and it broke down. But right now, it's sitting on a bit of a. It looked a little bit solider about an hour ago when we were up here, where we were wicking up. But these wicks below the 200 EMA on the 1 hour look promising. I mean, if this holds a support and we push up towards the 100 SMA in the hourly, it looks really good. Um, I don't expect it necessarily to fall down. That doesn't make much sense. But if it does, let me go to the 4 hour, and we look like we could be in for a decent drop. I don't. The reason I don't expect it to fall that low is because we already fell that low not too long ago, like a week or two ago. Do we really expect another 20% drop so soon? So I don't know. I'm a little bit more bullish than that. And we got rounding bottoms on the RSI. Let me show you that. Is it here? Yeah. I don't know why these aren't lining up. Let's move. That's why, because it's further back. Why are my markings not lining up? All right, there we go. That helps. No, was it on the 1 hour? Sorry, guys. I had nice. There we go. They were on the 1 hour. That's why. All right, so check this out. So back in February, February 18th, this thing started ripping up very nicely. And we had a mini blow off top, and that's the way these things work. And we had the RSI peak towards 100. It rips to the upside, it breaks down. But look at the difference. Look at the difference between the peak of RSI and the dip down to oversold. That's a significant dip. And then compare that to what we got going on right now. Notice the highlights. You got RSI overbought, RSI oversold, and we held at the 200 EMA going through RSI oversold. This was a double dip down to RSI oversold, and right now we're in the same type of territory. So, with RSI completely oversold, yeah, sure, we could double dip down on the RSI, but we have the 200 SMA and 200 EMA providing significant support. So, gut instinct, probably not going to dip below it. Probably. No such thing as a guarantee, but there's data to indicate we already went through oversold, and we're comparing it to the last cycle about a week or two ago. We were much dippier last time, so to speak. So there's much more support. And to top it all off, this was one heck of a rip up here. You see this? You see this dip and a rip? That was one heck of a buying pressure. That was pretty cool to watch it really go down and then really go up in a matter of like 2 hours. That was crazy to watch. That's why I was actually bullish that the descending broadening wedge would actually break out. But it didn't. It broke down, and this is what happens when you have a breakdown in the crypto space. But look at this wick down below the 200 SMA. That's pretty cool. So overall, I'm quite bullish. I'm even more bullish when looking at Ethereum. And this was my strategy. This was my play. So when you're up at trend resistance, you're going to see Aave yields pretty cheap. You're talking about like 8-10% on USDT, 8-10% on USDC, 8-10% on DAI as well. Right now, USDC is relatively still cheap at 10.89%, which means most people aren't going full risk on. When you see full risk on, you're up at 20-30% also for USDC. You'll notice that the total borrow, they'll probably be more or less the same size as the market size. This thing will rip up another 20 mil borrow, and you pretty much be at like 280, 285 on the borrow against the market size. And you're not going to want to borrow at a stable rate of 20 to 30%, but you want to borrow at a stable rate of like 8 to 10%. And that's the name of the game. So when you're up here and trend resistance and velocity starts to slow and people are repaying debt and they're worried that there's going to be a breakdown, people are repaying, and that's dropping the stable rates. So on the contrary, if you're bullish, at least on a decent time horizon, not like 5 minutes, not like you want to capitalize on this leg down. Plenty of people do. You could borrow Ethereum. How do you capitalize on this leg down? You borrow Ethereum. Look at that, Ethereum 6.8%, which means people are actually shorting Ethereum. They're borrowing Ethereum and likely selling it for dollars. And that's exactly the way shorting works in the equity space. You borrow the asset and sell it, and you receive a cash deposit. So it's a short sale. But shorting Ethereum here is a similar process, except it's DeFi and you have full control. Let's go back to Ethereum. So people are borrowing Ethereum. They're borrowing Ethereum here at the bottom of trend formation. I don't know. We got a rounding bottom on the MACD. RSI looks relatively bottomed on the 1 hour. And then you zoom out to like the daily. No, not the daily. Is it the weekly? And the weekly, and you're just coming out of oversold. And RSI is still high. So to me, this is bullish or bullish territory. Clearly, nothing is guaranteed, especially the fact, look at the 4 hour. 4 hours completely oversold on the RSI, Stoke RSI with a rounding bottom on the RSI. So that looks pretty cool. And this is a heck of a wick down right here that pulled all the way up like a straw. So what could you do in a situation like this? So I borrowed last night. I leveraged probably about 10% of the entire portfolio to borrow dollars using Bitcoin and Ethereum. Actually, the Ethereum that I bought with the dollars as collateral to back the loan. So about 10% of the portfolio, give or take, maybe 15%, something like that. Yeah, about 15%. That's about right. 14, 13 and a half. Something like that. Point being, so I locked in about 9% rates on dollars instead of what is the prevailing rate. I like to borrow USDT because if there's ever a problem with USDT, if you borrow USDT and sell it, you're shorting USDT, which means if there's ever like a deep peg and it goes to 80 cents, you only have to pay back 80 cents on the dollar and you're saving an absolute fortune. You're basically making 20% gains just by borrowing USDT. So, but last night, USDT was not as cheap as I wanted. So USDC was actually about 9%. So that was where I went for a fair amount of capital. So I bought Ethereum up here. And because of the trend formation, I knew the rates were cheap. I knew it was probably going to dip and it was going to stay within trend. And clearly there's risk in that. But this was where conviction and technical analysis and conviction in technical analysis comes into the picture. I expected it to dip and I was hopeful that it would hold. It would have been nice to see it hold above the 200 EMA, SMA, and the hourly, but look where we are in the 4 hour. 4 hour, we're above all. And we're about to have a 100 SMA, 200 EMA bullish cross, which is really cool. So this trend formation looks spot on. It's not fully an ascending triangle, but has a symmetrical shape to it. But it's more so ascending triangle. 2 touch points on resistance, 3 touch points, 4 touch points, depending on the time frame that you look at, on support. So this is quite bullish to me, especially that we're completely oversold on the Stoke and a rounding bottom on the RSI. It looks like that 200 SMA is going to hold. So that's how you do risk on. There is technical data suggesting there's more likelihood than less for appreciation rather than depreciation. And that's when you borrow. But you have to borrow, unfortunately, at the top. Got to have conviction that the trend formation is going to actually play out as one would expect. Because if you borrow down here, you're borrowing it. I mean, it's actually not much worse if you're borrowing USDC. So I could have saved a fair amount of money. Because I go, this is lucky right here. There happens to be a fair amount of USDC capital available. Because otherwise, look, 37, 22, 25. You'd be borrowing probably USDC under less speculative circumstances at about 20, the same rates, 20, 30%. But there just happens to be excess capital. But you don't necessarily want to gamble that. You don't want to take the risk that, if it dips down and it hits support on the trend, you're going to have to borrow 20, 30%. No one's going to want to do that. But if you could borrow at 9% when everyone else is being forced to borrow in the 20, 30% range, that's a massive difference. That's a 100% difference on the interest rate. So that's exactly the situation. 9% borrow, it dips down, trend support holds, and boom, it'll go back up. You have conviction in the technical analysis, and obviously the fundamentals we don't even have to discuss for Ethereum. Let's keep it going. Carlos almost missed this due to the time change. Sorry. Yeah, there was a big difference in time change, an hour. Drives me nuts. Lewis, shout out to Ben, Change Angel, for sponsoring Noah on the stream. Ben's a good guy. The whole Change Angel crew's good people. Dr. T, morning. Chet's in the house. Wasabi. William Blanc, so you borrowed USDC and bought Ethereum at high? Confused. Yes. Well, I borrowed USDC because the rates were cheap. The rates are cheap when you're at trend resistance because the velocity is going down. When you hit trend support or like a price action support or a long-term moving average support, the rates are going to spike because that's when velocity increases and people are speculating that it's going to go back up. But the whole goal is really to have conviction in a particular trend formation and define an opportune rate. The failure, or at least the risk that I took, or at least the risk that I wanted to avoid, was that typically when you get to trend resistance, you start to see the velocity bump, and look, it's 37% to borrow DAI, 22% and 25% to borrow True USD and USDT. This is an anomaly, being able to borrow at 10.89% when these other stable coins are twice the amount of interest rate. So you can't bank on this. There's a risk. I didn't want to take that risk, so I'm able to lock in about 9% towards trend resistance, expecting trend support to hold and it eventually to break out. So, a lot of trading like that is counterintuitive. And that's the name of the game, William. Bought ETH with borrowed dollars. Yes, that's correct. DigiGlide, what can we do with RenDGB? You're not going to be able to do much with RenDGB until Aave or another equity access source integrates an implementation. Aave would be fire for RenDGB. Flare would be fire for RenDGB when they get off the ground and they actually deploy DeFi. Which is basically lending and borrowing protocols and other protocols that translate risk into yield, which are the AMMs. And that's coming. There will be use case for NDGB. There's what, 700 to $1 billion worth of equity available, and that's the whole point. That's what these protocols facilitate is equity access, which is leverage. If you have $100,000 worth of Digibyte, I want to borrow 25 grand and turn 25 grand into 50 grand, and you still have your Digibyte. That's the whole point, equity access. And that's how the legacy financial system works. And that's why DeFi is absolutely explosive, because you can now access equity in assets without having to liquidate equity. So that facilitates growth and value creation. And that's how the financial system works. Yeah, before interest rates went to basically zero, and inflation is puts minus 15% pressure on your dollars, and the whole system is basically, I don't see it working, at least not for the general public. You can't keep dollars in a bank account. You're guaranteed to lose money. You're forced to take risk because risk is better than a guaranteed loss of money. How about that? No, William, that makes sense, because it's counterintuitive and it's contrarian. You would think that if you think Ethereum is going to go down, you don't buy it, but then you don't get the cheap rates because um, the, you have to have conviction in the trend formation that, yes, sure, Ethereum is going to go down. It's going to find support. You lock in the cheap rates. I didn't expect, no one could have expected, you can't predict that rates are going to be 10.8% on USDC when the rates on DAI, True USD, and USDT are twice as much. This is an anomaly right now. So they have a surplus of capital available, facilitating the lower stable rate. So you can't bank on that. Who's going to want to borrow USDC at like 25%? Sure, you can, but that you're gonna have to borrow that for a shorter duration than if you're borrowing at 9%. If I'm borrowing at 9%, I could hold the long position, the leverage position, for a bit more time, actually twice as much the amount of time without incurring a comparable amount of interest. Albeit the amount of leverage I got going on, I could hold it for a fair amount of time, considering the appreciation that everyone expects for Ethereum in the relatively short term, a month or two. Not even that much cap. It doesn't cost much for at 9%, in my opinion, per year. Black Sun, I think it's only stupid not to ask. Ask everything, guys, because you know even I need the questions. Ask me the questions because they help me explain my rationale and my thought process going into these types of decisions. It's quite counterintuitive. If you expect Ethereum to go down, you're going to borrow money to buy it because there's an opportunity to lock in a cheap rate. Now, I guess many people would think that that's silly. Wait for the bottom, wait for support, and then you have more reason to think it's going to go up. So you could take the higher interest rate but then you're going to have to take it for a shorter period of time. If you could lock in a low rate, you could take it for a longer period of time. What if it does this? What if it takes 3 days to get through this cycle? Boom, boom, boom. So you're going to owe twice as much money to pay back the debt? Eats into your profits. Just saying. What else do I got up here? A couple of interesting things. I got ArmorFi up. This is insurance, so smart cover is really cool. Let's see if it'll connect, and I'll show you guys. For some reason, it undercalculates my Aave position. So you actually get yield in the denominator in Armor. So I'm insuring my 1-inch position. I don't want to pull that up. And by the way, 1-inch is actually doing good. I'll flip back to this in a second. So 1-inch bounced off resistance, and this is a massive trend resistance. You guys got to see this. Let's zoom out to the 4-hour. Let's zoom out to the daily on this bad boy. This thing looks really cool. So there was this falling wedge, which broke up, but it revealed this relatively larger falling wedge. I don't really think it's a descending triangle. But point being, it basically smacked into resistance this morning. We got the rounding bottom, obviously coming out of oversold on the daily Stoke. We got the rounding bottom on the RSI, and it's clearly not even an oversold territory, which could be bullish, especially if it breaks to a new higher high. And then you got the MACD. Check this out. MACD is pointing towards the signal. So we had the big rip to the upside, which took us into the $5 range. We had the big pullback, but now look at this much reduced profile on the MACD. And now the upswing. If we see a bullish breakout on this thing's going to go $1. It's going to easily go $1. Maybe even more. Likely even more. There's no reason it won't go back to $455. It broke this morning just up the trend resistance from like $3.75 to $4.30. Incredible. Nikolai, if you have the conviction, would you ever want to borrow the stables and wait to buy the Ethereum until it hits support? Yeah, that's if you have capital. Let's say you have Bitcoin. Do you want to sell your Bitcoin? I don't want to sell my damn Bitcoin. So I use the Bitcoin and Aave as collateral to borrow dollars. See what I'm saying? So that's why it's called the leverage position. I don't want to liquidate the Bitcoin. The Bitcoin is what you want to accumulate using other assets to make gains. And then the Bitcoin you can leverage for dollars and throw it in the Bancor for 100% AP, APR. It's not all compounded. That's how that works. Heirloom, a place to learn to think about currency and investing. Yeah, this is all about currency and investing, and this is all about the legacy financial system as well. To really understand the crypto space and how to allocate value in this, there's little to no difference between this and the legacy financial system. We draw from history, we draw from experience, and we're able to make comparison and see analogy to how old systems worked. And it's pretty evident at this point why these new systems are better. um, I don't even think it's debatable or really at all. Even in their nascent stage, just starting to grow up, these systems are so far superior. I mean, guys, they're permissionless. You got $1 million, you could borrow $250,000 in about 30 seconds. About 30 seconds. No questions asked. I mean, literally, click a couple buttons and you can borrow the money. I'm just saying, that's crazy. Nikolai, borrow at top like you did, but not buy until later. Oh, yeah. All right, you see what I'm saying? But then what if it breaks out? What if it breaks out? Nobody knows what the heck's going to happen. Price action doesn't work like that. All you're doing is talking about odds of something going on. I mean, this was really bullish last night, albeit obviously RSI was maxed out. You can see in the 4 hour. So RSI, our Stoke RSI was maxed out. RSI wasn't maxed out though. Wasn't even above 80. RSI could have ripped to 100, and this thing could have easily gone to $2,200 in a single swing. And look, it was so this was a last night when this thing was right at resistance. Look at the MACD. It was a bullish signal cross. You see what I'm saying, Nikolai? So you know, the whole point of allocating value is using data is that you're right 51% of the time. And this was kind of a win-win to buy up here. If it breaks out, yay. If it didn't break out, you got 2 hits of trend support right here, and you got these long-term moving averages that would have provided support, and there was a great deal of likelihood that you were going to find support in this region, and that is exactly what played out. So getting in here, you were covered if it kept going to the upside, which the RSI easily could have swung to 100. Just like I mentioned, we could have seen $2,200 on a full trend breakout, and then it would just keep on going. Or if it breaks down, you got the trend. Trend is your friend. Conviction in the trend. So, but you make a good point. You could borrow the dollars and you don't necessarily have to do anything with it. Throw it back into Aave for 8% interest while you're sitting. You literally borrow money. Borrow money from Aave, throw it right back into Aave. You're borrowing it 8-9% depending when you lock in as a stable rate, and then you could easily be getting like 8-9% interest on the money you borrowed. Break even. You're literally paying no interest, but you're holding capital. You're holding excess capital. You have excess liquidity, and that makes all the difference for creating capital gains. Capital gains taxes. How about that? Um, William says, except we are the Rothschilds now. Yeah, this is banking, especially when you're talking about LP positions. You're providing capital to facilitate exchanges. And when you're talking about Aave, you're providing capital to facilitate equity access and leverage and debt. And that's basically what I refer to nowadays when I talk about Aave. It's really all about Aave. They got billions, and this is small potatoes compared to where it's going to be in a year or two. We'll easily see 30, 40, 50 billion. But this is monetary velocity. When you see the deposit APY go down and go up, you literally have the dynamic interest rates. Can you imagine a bank? No, the banks are stupid. They literally track interest rates relative to bonds, relative to Fed interbank monetary policy, and this just there's nothing interesting whatsoever about the legacy financial system and how it's constructed and how the variables and the parameters are modified. It's literally boring and annoying. Whereas literally, if people want to borrow, your interest rates go up to basically control the amount borrowed versus the available liquidity. And as people pay off debts and you have more liquidity available than the total borrowed, the interest rates go down and you can borrow for cheaper. I mean, literally, this is an it's an it's an automatic financial system that adapts and adjusts the parameters in real time. Or you can wait 3 months for the Fed committee to meet it's stupid. It literally is. It makes no sense. This, and I'm not even the youngest, but I'm 38, but tech and the way this works is so far superior to anything any government on the planet possibly does with central banking. And that's just one example. This is just one site dealing with interest rates and monetary velocity. Just one example of it. Yeah, Nikolai, you see what I'm saying? There's no perfect way to do anything. In the end, no matter what you do, you're taking a risk, unless you're risk off. But if you're risk off, you're not making gains. You're making 20, 30, 40, 50% a year. Well, that changes everything. But if you got 10 grand to invest making that kind of interest, sure, if you're 19, 18 years old, 20 years old, it'll compound over a decade. But if you're 30, 40, 50 years old, you don't necessarily want to wait a decade to make $100,000. So that's when you take more risk. It's all about risk analysis, and understanding the amount of risk you're actually taking. That's how you play this game. This game has nothing to do with making money. This game has everything to do with assessing your risk. So you can make money, but more importantly, you have to make more money than you lose. You have to win 51% of the time. You have to protect the downside. You have to know when to go risk off by looking at technical data. For instance, I'm probably about like 100 grand in the hole right now. And if this thing breaks down, and if it breaks down through these EMAs, I'm going to start getting nervous if it broke down through the 200 SMA right here. But if it broke down through the 200 EMA and the 100 SMA, I'm pulling the plug and I'll lock in those losses. And that's the way that works. You're taking a risk. I got the risk on. I'm well aware of the risk that I have on the table, and I know when to pull the plug. And there'll be another opportunity to make those gains back, but you have to wait and be patient and look for the trend setup. It's all about trends, so the odds are in your favor. Technical data gives you the edge, the house edge. It's literally talking about a casino and how it operates. You want the house edge, 51%. If you win 51% of the time, that's how you grow value. William Blanc, awesome question. Yeah, it's good, right? So both of them work. Borrow the capital when the rates are cheap. You buy Ethereum lower. That's if Ethereum drops in price and falls back towards support in the trend formation, which there was good reason to think that it would. Albeit, it's Ethereum, and RSI wasn't even at 100. And MACD just had a bullish signal cross. You see where the mouse is right now? MACD had a bullish signal cross last night. There was great reason to think that that would break out to the upside. And so be it, it hit resistance. And that's the name of the game. So, all right, ladies and gentlemen, 12:06 p.m. on a Monday, March 15th. That's a fun topic today. I haven't talked about risk on. I'm mostly risk off. And I'm mostly risk off. I'm mostly protective of value. But bear in mind, the most important thing to really learn is how to protect your value. Why? Because that's what you're going to want to do the vast majority of the time when you make it. You're sitting back and risk off, looking for a risk on opportunity. Picky to buy, quick to sell. You quick to sell to protect your capital. Sitting back on the sidelines, scoping like a hawk, scoping like an eagle, looking for prey, looking for an opportune time to get in. You stick to conviction, let the play out. And that was my conviction right there. If it broke out, great. If it dipped down, I expected support to get hit. If it breaks down lower, I'm going to cut my losses, get back into risk off, reassess my territory, and look for another opportunity. And that's how we do it. As I said, 12:07 p.m. on a Monday, March 15th. Through 36 people in the stream, 18 likes. We can do better. Thank everyone for joining. Tell everyone to subscribe, and I will see you tomorrow. Peace.